Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. It's generally related to three different topics and/or financial topics. So we're going to dive in there. We're going to take a look and see what people are sharing. If you want to follow me, it's at @finance, and if you want to join our community, findinghighvalue.com. I look at all this data, look at all what's out there, technical analysis, ratios, everything. And then I try to boil it down to actionable things. What looks good? Why does it look good? What are some good investments? So basically, I boil down all this information to look for potential investments. And that is across the board, across the spectrum, cash flow, developers, explorers, whatever it is. We do have that coupon code Mayday that is still active. So Lance says back to the 7 handle. The average 30-year fixed mortgage rate jumps today to 7%. And we've seen a big move in interest rates. So I'm curious to see how the housing market is going to absorb these higher rates. I think it's not going to like it. So we'll see where rates go in the future. Right now, there's momentum to the upside in that 10-year yield, and that's kind of where mortgage rates follows that 10-year yield. But right now, momentum's up. A4 Alpha, TMF, today is a good day. For those of you paying close attention to energy spot markets versus the equities, you will know exactly why. Adding across the board would recommend if you have the means. Next is earnings, is his opinion. And yeah, we see this disconnect between oil, the physical price of oil and the futures pricing, and the equities. It's almost like they pushed the price down of oil, and we got that initial surge down in the equity prices, and then we see people acquiring it across the board as we come off those lows. Yeah, it's a little bit interesting. Tavi says it's hard to ignore this massive inverse head and shoulders in the TSX Venture today. For those unfamiliar, this index is about as close to get as it gets to a benchmark for mining microcaps, with 48% of its composition in materials and a median market cap of 155 million. Shoulder, head, shoulder potentially with a upward rising trend line perhaps. And this would have to scribe out the shoulder. So it's a inverted head and shoulders is what he's potentially seeing. And this is an extension of what someone might draw with commodities. If the TSX Venture is going to go up, well then, AKA people are positioning in commodities. And you can make those claims. What you want to do is you want to take all this data, a bunch of different chart patterns in the markets, and then you want to sum them up because that's how money is flowing in the market. I don't care what someone says. I care how someone is positioning. If they say that, oh yeah, Nvidia is great, but then they go buy a bunch of commodity stocks, well, that's where I want to be. I want to be where they're buying. I don't want to be what they're flapping their jaw with. So the patterns and the technicals can tell you how people are positioning and where money's flowing. At least the big boys and where a lot of money is positioning. Risk of a lost decade for the 60/40 portfolio from 2022 remains. Lost decades for those portfolios have been relatively frequent and often followed strong bull markets. Real total return performance of the US 60/40 portfolio monthly rebalancing, the orange shaded areas denotes lost decades. So this was a lost decade that was also, I should say this is a lost decade, but in this period over here is where we actually had a big commodity bull market. Commodity bull market here, commodity bull market here, and I think we are probably entering another lost decade for the 60/40 portfolio. And the reason I think that is because we're entering a commodity bull market. And we are entering also an expansionary phase of real estate, which was this phase here and this phase here. It was both of these two phases of these last decades where we had a demographic that came into home buying years that was larger and created credit in the system. That credit creation is what's causing this move because interest rates go up with it. It could also be a more pronounced lost decade because interest rates also broke its 40-year downtrend and are starting to break out of that. So not only are we breaking the downtrend, it's a 40-year downtrend. It's a big paradigm shift. And sometimes it takes a little bit of movement to get people to have to change their old habits. So I think people are still stuck on the 40-year downtrend in interest rates, and they still think the 60-40 will work. I am in disagreement. I think the 60-40 portfolio that would do very well is more in line with 40% gold, replacing gold, silver, hard assets, precious metals, replacing bonds. Because when interest rates go up, it puts a lot of pressure on the bond market in terms of bond prices going down, and it can also put a lot of pressure on the stock market. So that's where I'm gaining in. And these sideways moves is that pressure being applied. So all of these pressure moves, they're generally from interest rates. 1940, that was a bottom for interest rates too. So bottom of interest rates, high interest rates. This interest rates went up a little bit here, credit expansion. I think we've got a bottom of interest rates right where we're at. COVID-19 was the bottom. It's possible. Why the face? You like that, how I converted that. Oil at $50 with inventory below 400 million barrels. Time to close my Twitter account, I think. And it says, I would say it's possible to have WTI less than 50 with crude inventories less than 400 million barrels. Of course, it's possible for WTI to be at 90 in that case. Not saying we see 50 oil, but you said possible. And that's the argument going back and forth. How can we go down to $50 a barrel and have very little inventory of it? It doesn't make sense, is what I think a lot of these people are coming to conclusion. Now, a lot of people are calling out $55 oil, $50 oil. We're going to get this big pullback. But it's almost like they're going blind to what's actually occurring in the physical market. It's like no one cares about the physical market anymore. We have low inventories. We've got high record demand, and it's like nobody cares. And does that matter? I mean, if the paper markets push it lower, that's where it's going to go. But I think it's the wrong outlook. Now, maybe they know something that I don't know. Maybe they know that there is a false flag event coming. Maybe they know that the government's going to do something where it's going to push things down. Maybe they know that there's a banking crisis that's coming, and that the banks need to get another bailout, and maybe that's going to push oil down in the short term. That is all possible. It definitely is possible. But I am not privy to that information. if people do know it in the system. Here's oil ban. It says, and yet backwardation still holds. I'm with OPEC here. These paper markets are a damn joke. So this is crude oil futures curve. It's still in backwardation. So what's going on here? What is going on? Egon says, I reiterate that I have repeatedly stated the 40-year rate cycle bottomed in 2020. That's that rate, the 10-year and stuff like that I said bottomed up during COVID. And the long-term trend is now upward. I anticipate interest rates exceeding 10% for many years to come, similar to the 1970s, likely starting as early as 2025. So, I mean, that's an opinion, but that opinion is backed by us breaking that big long-term downtrend. And you know what? Let me go in there. I'll show you that big downtrend that he's talking about. I'm going to use the 10-year as our measuring stick. So what they're talking about is this big move up of interest rates, the 40-year decline, and then we have another big move upward in interest rates. A lot of people are saying that 40-year downtrend is done, and that we could see a move higher. That is why I think the 60-40 portfolio is done. Because as this goes up, it's going to reprice stocks and bonds. Bonds for sure, and this is the price of bonds. This is bonds. Yeah, you can see my awesome thing here. That's what we're seeing there. It's a shoulder, head, shoulder. A shoulder, head, shoulder is an end of trend move. What you're going to see on oil companies is this inverted. It's going to be a shoulder, head, shoulder. We're scribing out the right-hand shoulder in energy companies. That's a bottoming pattern, and this is an end of trend. A lot of people say, oh, it's like got a head and shoulders, and it's like this small little pattern that's like down here. It's like, that's not really what head and shoulders patterns generally show. They show end of trend moves. We also see an end of trend move in the 10-year. If you look at the 10-year again, there's a end of trend shoulder, head, shoulder. And that's the topping pattern of TLT inverted. And then we're moving on up. So could we get a pullback? A lot of people said we're going to get this big pullback where we get a slowdown in the market. It's possible, yes. And that could be a breakdown of this, a retest, and then we roll over. But there's also people, a whole bunch of other people are in the camp that we continue higher. And I don't know which direction. I don't really have an opinion here. I'm kind of in the middle camp saying, how is this going to play out? And in the short term, I don't really know. It could pull back. We could get a slowdown. In the longer term, I think we go up in the longer term. So I'm playing and positioning for the bigger move, which is I bought a whole bunch of stuff here for this breakout, which we got. And now I'm playing the move higher, not necessarily the short-term little move lower. And then I buy a bunch of stuff that works in different market conditions. And that's what we'll go over during the weekend question and answer session, how that all kind of plays together. A few years now of buyback data performance, and you can see the impact on share price performance. My views, if you have an asset and cap structure to commit to a sustained buyback return on capital strategy, it's only a matter of time before material price performance is realized. NBC charts below are worthy of your time, and you can see who's doing the big buybacks. Year-to-date buyback progress, there's a whole bunch over here, and this is the total share price performance from 2022 till now. And some of these, they're buying back a lot of shares. These are the areas that I would focus on, are the share buyback areas. To me, that's kind of like picking up free money. And these guys that have a lot of cash flow generation, and if we get higher prices in oil, these things are going to be ridiculous, absolutely ridiculous in terms of total price performance in dividends and share buybacks and total return to shareholders. So I'm a little dumbfounded when someone will bring up like a similar company, but they don't do share buybacks. They're not cash flowing. And it's kind of like you really want to take on all the risk in the world when you have these companies out here that are incredibly cheap. You've got oil at a 40-to-1 ratio to gold, basically. And if that reverses, it's one big leverage play to the oil price. Now, obviously, you have to be a bull on oil, but these things are like premium ways to play a bull market. But some people say, you know what? I'm going to go speculate on a company that's going to dilute me to death. And you've got these companies that exist that are cheap and at a 40-to-1 ratio of oil to gold. I just shake my head and I just ask them, what are you doing? What are you doing? like these are base hits all day, and base hits win the game. You don't need home runs or I mean, some of these are going to turn out to be home runs. I mean, absolute home runs. BNN McGlone crap show, oil headed to $40, global recession, blah, blah, blah. That McGlone guy, he doesn't get that much right. Now, here's the thing. A lot of these guys that make all these predictions, go back to 2005, 6, 7, 8, 9, 10, go back through the 2010s. Go see what they've said, and then compare what their success rate is. And I'm going to tell you something. It's pretty crappy. A lot of these guys make all these predictions, and I know there's a lot of people on YouTube listening to a lot of YouTube clips to try to gain an advantage to make money in the markets. I did the same thing as you guys. Exactly the same thing. I was trying to learn as much as I possibly could and get as much information from YouTube that I could to convert it into becoming a better investor. Most of these guys are a clown show. Most of them. And most of their predictions are wrong. So I think what you want to do if you want to become a better investor is you want to mimic where people are good and they can consistently get returns over periods of time. You're always going to have these people that make a lot of money in a short period of time, but then they go broke. So really what they are is they are big fat gamblers. The Jesse Livermores. And people will say, well, he was the best trader ever. The dude went broke 3 or 4 times and committed suicide at the end. If that's the best trader, then I probably wouldn't trade because the guy was literally just a gambler. He'd put everything on leverage. He'd make a big, huge move, make a ton of money, and then lose it all and give it all back. He couldn't consistently beat the market. So his strategy, in my opinion, was not good because it allowed him to go broke many, many times. He basically was a gambler. And most gamblers go broke many times over their life. So it's about getting the strategy correct where you can win in multiple market conditions and not get blown out, but still have a ton of upside leverage. That's where I want to be. I don't want to get blown out, but at the same time, I want to have a whole bunch of upside leverage. How do I adopt a strategy that does that? What do I need to do? And that's exactly what I'm going to go over during this week's question and answer session. I want to make sure everybody understands what I am doing and how I'm doing it. Now, does that mean and guarantee that you'll be up every single year? No, it doesn't guarantee anything. But what it does is it gives you a strategy and a mindset of how to develop a portfolio that can outperform in a wide variety of market conditions. And that's where I'll get into it. In Gold We Trust, it says, we already know gold performs exceptionally after rate cuts, but now let's look at mining stocks. So what do we have here? This is how do gold mining stocks perform after the first rate cut? And here's the first rate cut. This was plus 8% here. After this one, it was plus 31%, and then it had the dive bomb of everything selling off when 2008 deleveraging happened. And then right after the first rate cut here was up 56%. So it did pretty well when you look at those 3 timeframes. And now we are just after the first rate cut. So what would I focus on and what would I look for? I don't think the rate cut is necessarily the big driver here. What I think the big driver is that 10-year breaking its 40-year downtrend. And I think a lot of pressure is going to be applied to the bond market. I think that people are going to prefer gold and silver and those hard assets, platinum, palladium, over bonds. And that's the big deal. Not necessarily these first rate cuts that occurred in a 40-year decline of interest rates during this time, and this time. I think we're in totally different areas than this picture even shows. So I think we're in like 1970 or before that even, in the 40s or something like that. That's where I think we're at. I wouldn't even use this as a comparison, to be honest. HFI research, the lower 48 gas production, natural gas, is surging past 103 billion cubic feet per day as maintenance finishes with another 1 billion cubic feet per day coming from Matterhorn. Lower 48 gas production will reach 106 billion cubic feet per day before year end. The real test is coming soon here. So we're starting to see a surge in natural gas production here. Eric Nuttall says, give it a couple days, and I think oil recovers. His opinion. Martin says, markets won't care about U.S. shale output until it is forced to. I think the bearish narrative that has taken root over the past 12 months has hit both investors and oil company management teams extremely hard. You're close to the bottom only when all hope has been removed from the equation. Personally, I think November 5th will be a catalyst many are underestimating, in his opinion there. And here is break-even prices for new wells. Permian's at $70. You guys really think we can stay below 70 if your cost curve is at 70? I don't think so. We can only temporarily come down here. But if we go to $50 a barrel, it takes all of shale completely off. We've got Permian other. We've got non-shale US 66, Scoop Stack in Oklahoma 65, Permian Delaware is 64, Permian Midland is 62, and all other shales at 59. We go below 59. I mean, that's you're below the higher end of the cost curve or the lower end of the cost curve. Price has to go higher than, but obviously could do it in a short period of time for a period of time. If you don't see this oil move was scripted, you shouldn't be trading oil. And I agree. I think it is scripted. It's almost like if you look at the chart, you've got these big, green candlesticks, people buying it, and then out of nowhere we get this like algo triggering move. So we'll see what happens. I'm remaining positive on the sector. I'm not negative. Remember what happened in October of 2023 and May 2024 when we had a similar disconnect. It says, is oil sending us all a signal on yields? It says the April peak in oil also marked the peak in bond yields. Same story now, question mark. And we can see a disconnect between yields going up and oil price going down. Another thing that one could question is the oil market in the driving seat of yields anymore? And is there something bigger in this game that is driving yields, like a debt problem? Could be. Historically, what would drive inflation is oil, and oil and inflation would drive interest rates. But now it's kind of like, are we at a stage where things potentially are disconnecting? Maybe I don't know. We'll have to just continue to watch and see. You can see how this is mirrored, though. You can see oil coming back down here in 2023, and you can see the move of interest rates following it lower. So you can see that oil was leading interest rates, and we'll see if that occurs. Grady says, been using this ratio chart plus many other charts, of course, as an additional tool for determining sector direction of precious metals and oil. Can post this one now as think it will be turning inside the massive blue triangle for the last time. Could we see the HUI, which is gold and silver mining companies, outperform XLE? We could for a period of time. We saw that big move in 2019 and 2020. That was also a slowdown. Could we get a slowdown that this comes all the way back up and then eventually oil will turn and bottom when it comes over here? We could. That is definitely a case. And there is data here showing this through this ratio here. Tobiasi Letter says, global investors are rushing into U.S. stocks like never before. Global inflows into U.S. stock ETFs reached $145 billion year to date, the most on record. This is $10 billion higher than the previous high since 2021 and double the amount posted last year. The vast majority of inflows at $105 billion came from Europe and $40 billion came from Asia Pacific region. For many, U.S. equities are now serving as a safe haven trade in times of economic uncertainty. Truly unprecedented. And I can tell you this too, guys. The bond market is eating crap. So they could be getting bond market money in here too. And everybody's just flowing into equities at this exact moment. Company says, you guys thought I was being sarcastic, but the algos know to sell every geopolitical event. And what he had is he posted this, how much will oil be down on Sunday night? Minus $5, 40%, minus 10, down limit, NYMEX needs a bailout. But $5 is what people said. And this was before the event occurred. Breakwave says, don't look now, but the Baltic Dry Index today hit its lowest point for this time of year in 7 years. So we are down here at a very low point for the Baltic Dry Index. Seasonally, it is a little bit lower down here. We do pull on back, but I think this is going to be a good opportunity to add some down here at some point for Baltic Dry Index. Biden administration given a huge gift from Netanyahu a week before U.S. elections. Watch the U.S. MSM print a bunch of negative pieces this week as everything, including the kitchen sink, to be thrown at the oil market before November 5th, which is the election. Then it all changes. So we'll see what happens here with crude oil and nat gas and all these other areas of them selling crap off in the news that they're releasing. Warren Buffett says, we don't get paid for activity, just for being right. And I absolutely love that. I don't want to do activity for the sake of doing activity, like a lot of 9 to 5 jobs. Oh, go sweep the floor. Oh, go do this. Oh, go do that. No, no, no. You get paid for being right and not the activity that's leading up to it. Warren Buffett says the best way to minimize risk is to think. And that's where we're going to end it, guys. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you guys later. This is Finding Value.